Now, the key point is, though, irrespective of your risk aversion, what are the two assets that you're holding? Bonds, and which portfolio of stocks are you holding? So it's called M. So everybody's holding M and bonds. If you're risk averse, what's the difference between somebody who's not very risk averse? You're putting most of your money in bonds and a little bit in stocks. If you're not very risk averse or you're quite risk tolerant, where are you putting most of your money? In stocks. And if you're even more risk tolerant, what are you doing? You're borrowing and levering up and putting the money in stocks. But the key point is that if everybody's holding the same portfolio of stocks, if everybody's holding the same portfolio of stocks, what must that portfolio be? Okay, well, let's work that out. So everybody holds M. What is M? Well, we know that demand for stocks must equal what in equilibrium? Supply. What's the demand for stocks? Well, everybody's demanding M. Let's suppose there are N units that are demanded of M. What's the supply of stocks? It's the market portfolio. That's what we said at the beginning. If you keep on adding stocks, eventually you end up with the market portfolio. That's all the stocks that are out there in valuated proportion. So what is M? It's some proportion of the market portfolio. Does everybody see that? That's the great power of the CAPM. We know that everybody's holding M and the risk-free bonds. So that's very important because now we don't need to know what people's risk aversions are because we know what they're going to be holding in terms of their portfolio, which is M. We can go out and measure M. We can look at its long-run expected return and its standard deviation. And we can plot it on our diagram, and we can actually draw this diagram. So what we've got now we've got the market, we've got the market M. We can measure the expected return on the market, RM, and we can measure the standard deviation on the market. We know the risk-free, so we can actually draw in this line. That's called the capital market line. And what it gives us is the risk-return trade-off that everybody faces. So if you want higher return, you can get it, but you're going to have a higher risk in your overall portfolio. But what we know is that everybody's going to be somewhere on this capital market line.
That should be, if P was negative, that would mean that you're shorting stocks to buy bonds?
So potentially, yes, you could short stocks to buy bonds, yes. And then you would not be earning very high returns, and you would have some risk still. So it's not a very good thing to do. It comes back down, yeah. Okay. So it's dominated. Now, what that means is that we can start saying some interesting things about returns and risk. So let's focus on these capital market line portfolios. And what we're going to do is we're going to call some portfolio on this line as having pi p in the market and 1 minus pi p in the risk-free. Now, what do we know about returns? Expected returns do what? Means add. So if we want to work out the expected return on that portfolio, it's going to be pi p times Rm plus 1 minus pi p times the risk-free. And we can rewrite that as Rf, that's the Rf times 1, and then we've got plus pi p Rm minus Rf. And what that's saying is, if you want a higher return on your portfolio on the capital market line, just put more and more in stocks. Now, if we're here, what do we know about pi p? It's 0, and what's the beta? If we're here, what's the beta of risk-free? 0. Okay, beta of risk-free is 0. As we move up, we get here, what's pi p here at m? 1. And what's beta p? Beta of the market's 1, so beta of that portfolio there is 1. So what's the relationship between pi and beta, do you think? They're the same. Let's just check that. Well, we know that betas add. So we know that the beta of a portfolio is pi p beta m plus 1 minus pi p beta risk-free. We know that's 0, though, so this term drops out. Beta m is, beta of the market is 1. And so we get beta p equals pi p. And so what we get here is that Rp is the risk-free plus beta p Rm minus Rf. So now what we've got, because we've nicely scaled betas so that the beta of the market is 1, is a risk-return relationship. We know that this risk-return trade-off on the capital market line gives us this expression, Rp equals Rf plus beta p Rm minus Rf. Now that's like the CAPM, except what does the CAPM hold for? Doesn't just hold for portfolios on the capital market line. What else does it hold for? Everything. The argument is that the CAPM holds for individual stocks. It holds for any portfolio that you want to do. It holds for everything. So why would that be, given that we know it holds on the capital market line? Well, what we're going to do is to use an arbitrage argument. Arbitrage is about how do you make money, and let's see how it works. Well, the key thing is that for a well-diversified portfolio, and remember M is as well-diversified as you can get, so we're going to be talking about well-diversified portfolios. What do we know about the risk of those portfolios? Remember back at the beginning we said the standard deviation of the well-diversified portfolio is equal to what? Remember back at the beginning we had Standard deviation of well-diversified portfolio is the beta of that portfolio times the standard deviation of the market. Now what we're going to do is to hold betas constant. As long as we hold betas constant, the risk of the portfolio is going to stay constant. And if we're keeping the risk the same, what can we focus on? Just focus on expected return. We want to maximize expected return for a given risk. So how does this... So we're going to hold beta constant. So let's take a stock. Let's say it's IBM. And let's measure its beta. So we've got the expected return and the beta of IBM. Let's suppose, for the sake of argument, that the beta of IBM is 0.9. Now, what we're going to do is to choose a portfolio on the capital market line. So we want to choose one of these portfolios along here which has the same beta. Let's call this portfolio star portfolio. So we're going to choose pi p star. What are we going to choose it as? We want it to have the same beta as IBM, so we know on this line pi p is equal to beta p, so we're going to choose 0.9 because that's going to give us beta p star equals 0.9. Okay. So we can go here. Where is the 0.9 portfolio going to be on here? It's got how much in the market? 0.9, 90%, 10% in bonds. So we're going to be somewhere like this. So this is going to give us RP star. And this is where we've got pi p star equals 0.9. We go here and we say, okay, we get RP star from that. Let's suppose that our IBM was greater than RP star. What do we want to do? We want to do what with IBM? We're holding risk the same, so which asset do you want? High return. So we want to buy IBM, and what are we going to sell in its place? We're going to sell this star portfolio. What's happened to the beta? Stays the same, so the risk's the same. What's happened to the expected return? It's gone up. Okay, so well, let's work it out. Okay, if everybody is buying IBM, what happens to the price? The price, if you buy, the price goes up. If the price goes up, what happens to the expected return? It's lowered, so this goes down. When's it going to stop? When they're equal. So our IBM has got to come into equality with R star P. Let's do it the other way around. Suppose we had our IBM was less than R P star. which one would you buy and which one would you sell? Sorry. So we would buy Star and we would sell IBM. Who wants to do that? Everybody? Everybody wants to get a higher return for the same risk. So what's going to happen to the price of IBM if everybody's selling it? It's going to go down. If the price goes down, what happens to the return? It goes up. So our IBM goes up. And that will happen until we get equality. Why are price and return inversely related? So what you've got is a fixed dividend in dollar terms. If the price goes up, what happens to the return? Well, it's the dividend over the price. It goes down. Okay, so price and return are inversely related. So what we know is that if this holds for our star portfolio, equal beta things must be equal return, otherwise there'd be an arbitrage opportunity. So what we get now is that our IBM is equal to the risk-free plus beta RM minus RF, where the beta is the beta of IBM. But if it holds for IBM, what else must it hold for? Everything. There's nothing special about IBM here. So what we know is that every stock, this must be true, otherwise people could make money. And that's the capital asset pricing model. Does everybody see what's going on there?